Imagine walking into a bank with, I don't know, $50,000 in cash just sitting in your checking account.
Right, totally flush with cash.
Yeah, and you sit down, ask the teller for just a basic entry-level credit card, and they flat out deny you.
Well, the person right next to you, who maybe has like 200 bucks to their name, gets approved instantly.
Exactly. Why? Well, because of a three-digit number. It's like one of the most frustrating paradoxes in modern life.
You need credit to get credit.
But nobody will give you credit because you don't have any credit to begin with.
It is the ultimate financial catch-22. But, that three-digit number isn't just a hurdle. It's a direct reflection of your financial reliability to the rest of the world.
A financial reputation, basically.
Exactly. A credit score is your financial reputation.
Yeah.
And understanding the actual mechanics behind how that number is generated is the key to unlocking almost every major life milestone.
Oh, for sure.
We're talking about buying a car, getting a mortgage, or even just passing a background check to rent an apartment.
And today, we are going completely under the hood to break that cycle. Welcome to a brand new deep dive.
Got to be here.
We have a massive stack of sources to pull from today, ranging from official guidance from government bureaus like the CFPB to insights from credit giants like Experian.
Plus, we've got comprehensive reports from financial platforms like Clear Value Lending, Finance Brewery, Masters Credit Consultants, and Zabel UK.
Right. So our mission today is to take all this data and map out a step-by-step blueprint for building a rock-solid financial reputation from absolute scratch.
A roadmap for the beginner.
Exactly. Okay, let's unpack this. Because before we can even talk about building a credit score, we have to understand what game we're actually playing.
Which is confusing for a lot of people.
So confusing. Because if you open up a free banking app on your phone right now, you might see a score of, say, 725.
A great score.
But then you walk into a car dealership, they pull your credit, and they say you have a 683.
Yeah, and for a beginner, that feels completely broken.
It really does.
It feels broken, but it's actually by design. The first thing you need to realize is that there isn't just one single credit score. You have dozens of them.
Wait, dozens?
Dozens. The entire system is built on two major scoring models, FICO and VantageScore.
Okay, FICO and VantageScore.
Right. Now, they both use the exact same scale, ranging from 300 on the low end to 850 on the high end, and they both pull data from your credit reports.
Yeah, but they're different companies.
Exactly. They're built by entirely different companies using different algorithms to weigh your financial habits.
So it's like taking a history test, but FICO and VantageScore are two different teachers grading your exact same answers using totally different rubrics.
That is a highly accurate way to look at it.
Like one teacher might dock you 5 points for a missed date while the other docks you 20.
Yes. And FICO is the heavyweight here. It's been around since 1989 and is used in over 90% of U.S. lending decisions.
So auto loans, personal loans, credit cards.
All of it. VantageScore was launched much later, in 2006, by the credit bureaus themselves. When you look at free consumer apps, like Credit Karma or your bank's native app, you are almost always looking at a VantageScore 3.0 or 4.0.
I have to push back on that, though.
Okay, go ahead.
If FICO is the one that 90% of lenders actually use in the real world, why do we even care about VantageScore on these free apps?
That's fair.
Isn't looking at a VantageScore just a distraction if the bank is going to pull a FICO score anyway?
This raises an important question, and it highlights one of the biggest hurdles for beginners. The reason VantageScore is incredibly useful when you're starting out comes down to how the algorithms handle time.
Time? How do you mean?
Well, FICO has a strict mathematical rule. You must have at least 6 months of active account history before their system will even generate a score for you.
Oh, wow, 6 months of nothing.
Right. They need to see a proven pattern of behavior. If you have a thin file, meaning very little credit history, FICO essentially treats you like a ghost for half a year.
Because, like, 1 or 2 payments just isn't enough data to build a reliable risk profile.
Precisely. VantageScore, however, operates on a much shorter timeline. It can generate a score for you after just a single month with one reported account.
Oh, that's a huge difference.
It is. So for a beginner, VantageScore is a vital tool for tracking your early progress and spotting general trends while you wait for FICO to finally kick in at the 6-month mark.
Okay, that makes sense. But the sources point out another massive layer of complexity here. Even within FICO itself, you aren't just dealing with one model.
Oh, right, the different FICO versions.
Yeah. FICO 8 is currently the most widely used model for general things like credit cards. But the sources highlight a huge insider reality check.
The mortgage industry.
Yes. When you eventually apply for a massive loan, like a mortgage, lenders completely ignore FICO 8. They use older models like FICO 2, 4, and 5.
They do.
Why on earth are they using outdated technology to make $500,000 decisions?
It comes down to risk aversion in the mortgage industry. We are talking about hundreds of thousands of dollars stretched over 30-year terms.
So they play it safe?
Extremely safe. The mortgage industry is heavily regulated and notoriously conservative. They don't want last year's algorithm, right? They want decades of proven historical modeling.
Wow.
They rely on FICO 2, 4, and 5 because those models have successfully predicted default rates through multiple economic crashes. They are incredibly strict.
And just to add one more variable to the mix, we have to talk about the bureaus themselves. You have Equifax, Experian, and TransUnion collecting all this data.
The big three.
But they don't share information with each other.
No, they are competitors.
Right. So a lender might only pay to report your payments to Experian. So if FICO pulls your Equifax file and VantageScore pulls your TransUnion file, you get totally different numbers because the underlying data itself is missing puzzle pieces.
Which is why the #1 rule of building credit is understanding that your score will fluctuate depending on who is pulling it, what model they are using, and which bureau they are checking.
Okay, so now that we know the landscape, that we are trying to survive that 6-month ghost period to get a real FICO score, how do you actually secure that very first account?
Because traditional lenders look at a blank report and instantly reject it.
Exactly. So what's the move?
You have to bypass the traditional lenders entirely and use starter tools designed specifically for the Catch-22. The most reliable entry point across all our sources is the secured credit card.
Oh, I love the mechanics of a secured card. I like to think of it as bowling with the bumpers up.
That's a good way to put it.
Yeah, you put down our refundable cash deposit up front. Let's say it's $200. That $200 deposit becomes your actual credit limit.
Right, your own money backs the card.
You swipe the card, you get a statement, and you pay it off using your checking account, just like a normal credit card. The deposit acts as the bumper.
Because if you stop paying your bill, they just keep your $200.
Exactly. It protects the bank from risk.
It removes the risk equation for the lender entirely, which is why approval odds are so high. And the psychological benefit here is the graduation component.
Graduation.
Yeah, after roughly 6 to 18 months of responsible use, many issuers will review your account. If you've proven you are reliable, they will actually mail your initial deposit back to you and upgrade the account to a standard unsecured credit card.
And that's crucial because your account number stays the same, meaning you get to keep all that valuable account age you just spent a year building.
And that continuous history is gold for the FICO algorithm.
But let's look at the alternatives. I mean, a secured card requires tying up your own cash. What if someone doesn't have $200 to lock away in a deposit? Or what if they're in college?
If you are actively enrolled in a college or university, a student card is usually your best option.
Are those unsecured?
Yes. These are unsecured, meaning no cash deposit is required, because lenders are essentially betting on your future earning potential. They want to capture you as a customer before you graduate and start making a high salary.
Okay, but what if you aren't a student and the idea of holding a credit card just terrifies you?
A lot of people are completely dead averse.
Yeah, they know they need a credit score to rent an apartment, but they refuse to carry plastic. Well, our sources outline a tool called a credit builder loan.
This is a fascinating mechanism. It's typically offered by credit unions or community banks. It functions like a reverse loan.
The reverse loan.
Yeah, instead of the bank giving you a lump sum of cash up front, they take the loan amount, say $500, and lock it away in a frozen savings account.
Okay.
You then make fixed monthly payments toward that $500 over a term of 6 to 24 months.
Wait, I have to stop you there. So I am paying a bank every single month for a chunk of money they haven't even given me yet?
That's right.
On the surface, that sounds like a scam.
Yeah.
How is that actually helping me?
It sounds counterintuitive, I know, but think about the mechanism from the bureau's perspective. The lender reports those monthly payments to the credit bureaus, meticulously building your payment history.
Ah, so you're buying the history.
Exactly. At the end of the term, once you've made every payment, the lender unlocks the savings account and hands you the $500. It's essentially a forced savings plan that builds credit simultaneously.
Why do banks even do that?
Credit unions offer these because their mandate is often to build community wealth and foster long-term financially healthy customers rather than just profiting off immediate interest.
That makes total sense when you frame it as forced savings. It completely eliminates the risk of you taking a loan and blowing the cash because you literally can't touch it until you've proven you can pay it.
Precisely.
There is also the authorized user hack. This is where you get added to someone else's existing credit card, like a parent or a spouse.
Right, piggybacking.
Yeah, you don't even need the physical card, but their entire positive payment history gets copy-pasted onto your blank report.
It is highly effective for jumpstarting a file, but there is a massive caveat. The sword swings both ways.
How so?
Well, if the primary cardholder misses a payment or maxes out their card, that negative data also gets copy-pasted onto your report, potentially ruining your score before you even start.
Ouch. So you better really trust that person.
Absolutely. Furthermore, regardless of whether you choose a secured card or a credit builder loan, you must verify that the issuer actually reports your activity to all three major credit bureaus.
Oh, because if they don't.
If they only report to one, or worse, none, your entire effort is invisible to future lenders.
Good point. Okay, here's where it gets really interesting. What if you don't want to open any new accounts at all?
The alternative data route.
Yeah, the financial tech world has completely exploded with alternative data tools lately. We're talking about things like Experian Boost and Ultra FICO.
Wow, popular right now.
Experian Boost literally connects to your bank account, scans your transaction history, and gives you credit for paying your utility bills, your phone bill, even your Netflix and Spotify subscriptions.
It's quite a shift.
It feels almost like a cheat code. You're telling me I can get a better credit score just by binge watching TV?
In a sense, yes. These platforms are designed to capture evidence of responsible financial management that traditional credit reports completely ignore.
What about Ultra FICO?
Ultra FICO looks at the cash flow in your checking and savings accounts. If you don't overdraw your account and keep a healthy buffer of cash, it generates an additional score to show lenders you are responsible.
And we absolutely have to mention the localization differences here because credit systems do not cross borders.
Very true.
If you are listening in the UK, none of your foreign credit history comes with you.
Yeah.
You are starting from absolute scratch.
And the UK system has a very distinct foundational requirement. The sources emphasize that getting on the electoral roll is an absolute must-do first step.
Which sounds weird to an American listener. Like, why does registering to vote matter to a bank?
Because in the UK, getting on the electoral roll isn't just about voting. It is the bedrock of identity verification.
Oh, interesting.
Credit agencies use that database to combat fraud and trace your address history over time. Without it, the algorithms view you as ghost, making it nearly impossible to get approved for anything.
The UK sources also highlight a brilliant service for renters called Zabel.
Yes, great tool.
Rent is usually a massive sunk cost that does nothing for your credit, but Zabel connects to your bank and reports your monthly rent payments to the bureaus, turning your biggest expense into a credit-building asset.
It's a huge advantage for renters.
But I have to ask the critical question regarding all this alternative data. Paying Netflix, linking your rent to an app, letting Ultra FICO scan your checking account. Does this alternative data actually work when you are applying for something massive, like a house?
This is the massive gotcha hidden in the fine print of the financial tech boom.
I knew it!
Tools like Experian Boost and Ultra FICO only affect the FICO 8 and FICO 9 scoring models.
And we already established that mortgage lenders don't use those models.
They don't. Fannie Mae and Freddie Mac, the massive government-sponsored entities that buy and back the vast majority of mortgages in the U.S., require lenders to use those older, stricter models.
Oh, wow.
Therefore, they fundamentally do not accept Experian Boost or Ultra FICO data.
So it's useless for buying a house.
Exactly. So while linking your Spotify account might give you the 10-point bump you need to get approved for a starter credit card, it is completely invisible to a mortgage underwriter. For the big milestones, you still need a traditional credit history.
That is a brutal reality check. So the cheat codes are great for the early levels of the game, but to pass the final boss, you have to play by the classic rules.
Which brings us to the actual rule book.
Right. Once you have the accounts open, how do you maximize the algorithm, and how do you avoid accidentally sabotaging yourself? Let's talk about the heavyweights.
The absolute foundation of your credit score, the metric that trumps everything else, is your payment history, which makes up what, 35%? It accounts for 35% of your FICO score and roughly 40% of your Vantage score. This is not a suggestion. It is a mathematical mandate. A single payment that is 30 days late can stay on your credit report for 7 years.
7 years of punishment for missing one due date by a few weeks. That's insane.
And for a beginner with a thin file, the sources show that one single late payment can tank your score by up to 110 points instantly.
110 points is the difference between getting a prime interest rate and being flat out denied.
It really is.
The second biggest factor is credit utilization, and this one trips up so many people because the mechanics aren't obvious.
People struggle with this one.
Utilization is simply how much of your available credit you're using. A lot of people visualize this as a pie, but I think a better analogy is the RPM gauge on a car's dashboard.
How so?
Well, think about it. If your car has a top speed of 100 miles per hour, but you're constantly driving it at 90 miles per hour, the engine is screaming. It's redlining.
Okay, I see where you're going.
Lenders view your credit limit the exact same way. If you have a $1,000 limit and you are constantly carrying a $900 balance, your finances are redlining. The bureaus assume you are starving for cash and are one emergency away from an engine failure.
That makes total sense.
The golden rule across all our sources is to keep your utilization under 30% of your total limit, but to really maximize your points, you want to keep that gauge under 10%.
That is an excellent way to conceptualize the risk from the lender's perspective. It's also worth noting a subtle architectural difference in the algorithms here.
What's the difference?
FICO 8 groups your overall balances and your utilization into one big 30% bucket called amounts owed. VantageScore actually splits them up, weighting utilization heavily at 20% and overall balances at 11%.
Oh, interesting.
But the behavioral advice remains identical across the board. Keep the needle on that RPM gauge as low as possible.
So those are the rules to win. But what about the traps? Our sources highlight a few major mistakes that beginners make that completely wipe out their progress. The first one is going on an application spree.
Yes, every time you apply for a credit card, the lender does a hard inquiry on your credit report. They pull your file to see if you are safe to lend to.
And that hurts your score, right?
One hard inquiry might knock a couple of points off your score, which is normal. But if you apply for 5 credit cards in a weekend because you're desperate for approval, those inquiries compound.
Because it looks desperate.
The algorithm flags you as someone urgently seeking debt, which plummets your score. You need to space your applications out by at least 6 months.
The next trap is so counterintuitive, and it catches so many responsible people off guard. Closing old accounts just because you finally paid them off.
A classic mistake.
You feel responsible, right? You say, I paid off this card, I don't need it anymore, I'm going to close it. Do not do this.
The math behind closing an account is unforgiving. Let's walk through it. Imagine you have 2 credit cards, each with a $1,000 limit. That gives you a total credit limit of $2,000.
Got it.
Let's say you have a $500 balance sitting on one of the cards. Your total utilization is $500 out of $2,000, which is 25%.
Right. You are under that 30% threshold, your RPM gauge is in the green, and you are in good shape.
Now, you decide to close the card that has the 0 balance because you aren't using it. The moment you close it, your total credit limit instantly shrinks from $2,000 down to $1,000.
Oh, no.
But you still have that $500 balance on the remaining card. Overnight, without spending a single new dime, your utilization spikes from 25% to 50%.
You just redlined your RPM gauge.
And your score will drop significantly.
It's a purely mathematical trap. You get punished for trying to be responsible. And the final trap the sources warn about is taking out an 84-month auto loan just to get a lower monthly payment.
If we connect this to the bigger picture, an 84-month auto loan is a massive red flag. Cars are depreciating assets. They lose value rapidly the second you drive them off the lot.
Fast.
If you stretch a loan out over 7 years, the car is going to lose value much faster than you are paying down the principal of the loan. You will quickly find yourself underwater, meaning you owe the bank more money than the car is actually worth.
And if that car gets totaled in an accident, or if you lose your job and need to sell it, the insurance or the sale price won't cover the loan. You have to pay the bank the difference out of pocket.
And if you don't have the cash...
It goes to collections, completely destroying the credit profile you spent years building.
Exactly. Building credit is a marathon of consistency, not a sprint for a lower monthly payment. And that marathon requires vigilance.
Even for people with good credit.
Complacency is a danger for everyone, even high earners. You get busy, you miss a single email, and suddenly you are 30 days late on a $15 subscription bill. That triggers the 7-year, 110-point penalty.
Which is devastating.
This is why automation is the ultimate safeguard. Setting up autopay for at least the minimum balance on every single account ensures that, no matter how chaotic life gets, your payment history remains flawless.
So what does this all mean? Whether you are scraping together a $200 deposit for your very first secured card, whether you are utilizing a credit union's credit builder loan, or whether you are just linking your Spotify and Netflix payments to Experian Boost to squeeze out a few extra points, you now have the exact blueprint.
You do.
You know the 6-month timeline, you know the mathematical traps of utilization, and you know how to take absolute control of your financial reputation.
But as we look at the trajectory of all these sources, I want to leave you with one final, broader implication to ponder.
Let's hear it.
We are moving incredibly fast into an era of alternative data. With UltraFICO monitoring the daily flow of your checking account, Experian Boost tracking your late-night streaming habits, and apps monitoring your rent and utility payments, the very definition of creditworthiness is fundamentally shifting.
It's getting so much more personal.
It is no longer just a measure of how you handle debt.
Yeah.
It is rapidly becoming a measure of how you live your daily life.
That is a wild shift in perspective when you really think about it.
It is, and the question we all have to mull over as this technology evolves is this. Where's the line between proving you are a reliable, responsible borrower and handing over a complete 360-degree financial surveillance profile to massive corporations?
Wow.
Just how much of your personal, daily lifestyle data are you willing to trade for